Let's talk about the cash flow statement in more detail. So with the income statement, we know that revenue minus expenses equals net income. But you know what? The income statement is a lie. It's a lie because it doesn't tell you the real cash balance or cash increase in your pocket. Income is not cash. Okay, so that's why we need to have a cash flow statement. So think about it this way. If you get paid, right, and you have a check, and the check is post-dated, right? You can't cash it for a couple of weeks. Then you didn't get that cash yet. And so the income statement is not correct. That's not revenue yet. I mean, it is revenue, but it's not cash revenue. Okay. So income is not always cash. So if we take the cash on the balance sheet at the end of year 2, and we deduct cash on the balance sheet at the end of year 1, does that equal net income? No. No, it doesn't. Not at all. Not at all. And that's why we have the cash flow statement. Okay, so the cash flow statement will tell you why cash increased on the balance sheet from one year to the next, or why cash decreased on the balance sheet from one year to the next. And so here's how you make a cash flow statement. You start with net income at the top, okay? And then you add back non-cash items from the income statement, like depreciation. And then you're going to add back non-cash items from the balance sheet. Okay, so step 1, let's do it. Get net income from the income statement, okay? And we've got it there. It's 3, right? We already did that last section. Step 2, add back non-cash expenses. Well, we've got depreciation of $1 for that truck. So we'll add that back. So we're at 4 now, okay? And we're done with the income statement portion. Now what we would do is we go to the balance sheet and add the non-cash items. But tell you what, I want you to watch the next lecture because I'm going to give you an example and then you'll have an exercise and this will all make perfect sense.